What if I told you there's one simple chart that predicted almost every recession in the last decades? And most people completely ignore it. It's called the yield curve. And once you understand this, you'll see the economy completely differently. What is a yield curve? Before we can fully understand what a yield curve is, we first need to look at where it comes from. In financial markets, there are several major asset classes: cryptocurrencies, stocks, commodities, real estate, foreign exchange, and bonds. The yield curve specifically belongs to the bond market. So, what exactly are bonds? A bond is essentially a loan. When you buy a bond, you're lending money to a government or a company. In return, they promise to pay you back your initial investment after a certain period of time, plus interest. The key factor here is time. The longer you lend your money, the higher the return you usually expect. For example, a 1-year bond will typically offer a lower return than a 10-year bond. Now, what is interest? Interest is the compensation you receive for taking on risk. And in financial markets, there are several types of risk: inflation risk, maturity risk, interest rate risk, credit risk, liquidity risk, currency risk, and regulatory risk. Most of these risks increase with time. If you lend money for just 1 month, very little can go wrong. But over 10 years, many things can change: economic conditions, inflation, or even the stability of the borrower. That's why time is such a crucial factor. Now that we understand bonds, let's define the yield curve. Let's look at this graph. On the x-axis, we have time to maturity, ranging from months to years. On the y-axis, we have the yield expressed as a percentage. In a normal economic environment, the yield curve slopes upward, from the bottom left to the top right. This means that longer-term bonds offer higher yields, which typically signals a healthy and growing economy. However, there is also the opposite case, an inverted yield curve. Here, the curve slopes downward from the top left to the bottom right. This is often seen as a warning sign that the economy is weakening and may be heading toward a recession. So, how does an inverted yield curve actually happen? To understand this, we need to know one fundamental relationship: bond prices and yields move in opposite directions. When bond prices go up, yields go down, and vice versa. This relationship becomes important when new bonds are issued. If newly issued bonds offer lower yields, older bonds with higher yields become more attractive. As a result, their prices increase to balance things out. Now, let's consider investor behavior. If investors start to believe that a recession is coming, they often shift their money into safer investments, like bonds. In particular, they tend to buy long-term bonds, which usually offer higher yields. When many investors buy these long-term bonds, demand increases. And as basic economics tells us, when demand rises and supply is limited, prices go up. And as we just discussed, when prices go up, yields go down. This is one of the key mechanisms behind an inverted yield curve. But why do investors rush into long-term bonds in the first place? In a strong economy, interest rates are typically high. If inflation rises, central banks often increase interest rates even further to slow down the economy. However, if rates become too high, this can push the economy into a recession. Investors anticipate this. They expect that interest rates will eventually fall again to stimulate economic growth. So, they try to lock in current high interest rates by buying long-term bonds now. Even if rates drop in the future, their bond will continue to pay the higher rate they secured earlier. For example, if interest rates are currently at 6%, an investor might buy a long-term bond today. If rates drop to 2% in the future, new bonds will offer much lower returns, but the investor still benefits from the original 6%. Finally, if we look at historical data, we can see how powerful this indicator really is. Data from the Federal Reserve shows the relationship between the yield spread, specifically the difference between 10-year and 3-month government bonds, and the probability of a recession. Historically, whenever this spread turns negative, meaning the yield curve inverts, the probability of a recession in the following months increases significantly. So, what's the key takeaway from all of this? It's actually quite simple. Whenever you see an inverted yield curve, it's often a strong signal that the economy is slowing down, and it can be an early warning sign of a potential recession. Thanks for watching this video. all the way to the end. I hope you found it valuable and learned something new. If you did, don't forget to like the video and subscribe to the channel, and I'll see you in the next one.